Welcome back, everybody, to VTS Options. So as we continue on with this free options trading basics course, I'm putting together all the various option types, and today's trade is an extension of the previous one. Last time I went over the standard butterfly spread, and today we'll modify that trade a little bit and do what's called a broken wing butterfly instead. Now, if you are already a member of the VTS Options community, you'll want to pay attention to this trade because it does directly relate to one of our other advanced option strategies. I have several that make up the actual portfolio of live trades we take, and the one that requires a broken wing butterfly is the strategy called directional flies. You'll see in a minute why it's called that. And just as a quick reminder, there is always a free trial available on the website if you want to check out some of our live trades and see if it suits your investing style. But with that, please smash that like button for me, and let's talk about broken wing butterflies. So first I'll talk about the theory behind the trade, we'll talk about the Greeks, and then I'll actually open up my trading platform and show you a real example. So as I went over in the previous video, this is what a standard at-the-money butterfly spread looks like. Please review that first video for more detail, but very quickly here, this is constructed in a single transaction by selling two contracts at the middle strike, in this case $60, and then buying one contract of each of the wings on either side of that. So here they are at $50 and $70. Now, because you're buying those wings, the maximum loss is capped at the premium paid. You can't lose more than that no matter what happens. So that standard at-the-money butterfly is a really great market-neutral strategy for when you're fairly indifferent about the price. You don't favor up or down, you just think it's going to remain fairly stable in that middle range. But what about when we do think one of those sides is more likely to get breached? We're not talking about outright long or short, we just mean that if you have a small bias, that's when the broken wing butterfly comes into play. So in our first example, let's assume that the trader felt the underlying price is more likely to go down than up. In that case, we'd do this. You can see it's a similar trade to before, where we benefit the most if the price stays in the middle range, but now the risk is not even on both sides. We have all the risk pushed out to the high side and none of the risk of loss on the downside. In fact, there's potential for a small profit on the downside. This is accomplished by selling two contracts at the middle strike of $60 and then buying one contract each on both sides. But this time it's $70 on the high side and $55 on the low side. We've broken the lower wing of the butterfly that was at the 50 strike and moved it to the $55 strike instead. Since in this example we felt the probability of the price going down was a little more than going up, it makes sense to shift the risk away from that low end. But now let's go the other way. This trade would be appropriate for anyone who thought the risk of the price going up was more than going down. All we've done is break the other wing and bring in that $70 strike to the 65 strike instead. We still want the price to remain close to the middle at 60. We don't want any risk on that high side. It's safer to just push it all down to the low side, and you'll see this illustrated more in my example shortly. But first, the Greeks are statistical values that provide us a way to measure the sensitivity of an option's value with respect to other factors. We have price, time, and volatility. Now, normal butterflies are delta neutral. They profit from a lack of movement in the underlying. Broken wing butterflies will have positive or negative delta, depending on which side of the trade we have shifted the risk over to. With respect to theta, broken wing butterflies are still theta positive, meaning they do gain value with the passage of time. And vega is the same as well, vega negative. They gain value with decreases in volatility. And this is essentially because we are selling twice as many of the middle strike as the two single contracts on the outside. So if volatility goes down, those short contracts in the middle profit. But now let's go over an example of a trade that I already have open in the VTS Options portfolio. Okay, so this is the Thinkorswim platform from TD Ameritrade. Now, your software is going to be very similar to this. Most of the platforms out there do have all the same functionality, but I like to use Thinkorswim just because it does look pretty nice on the videos. So what we're looking at here, this is a one-year chart of the NASDAQ. And just to keep things accessible for people on smaller trading accounts, we're going to use the ETF called QQQ. This is the Qs. Now, we can see that after the COVID crash earlier in the year, the NASDAQ has actually recovered very strongly, better than any other index. We can check out a few of the other ones here. This is the SPY, the S&P 500, and you can see it's very close, but it's still not quite to the previous level. We can check the Dow Jones. It's actually even more below where it was. The Russell 2000 index for small caps, you can see it's well below. And also the S&P 500 Mid-Cap ETF, this has been struggling a little bit as well. So it's actually the NASDAQ that has recovered very strongly. For my example today, this is the one I'm going to use for a broken wing butterfly. So I'm going to go over the Analyze tab here and pull up the option chain. Now I typically like to trade these monthly cycles. So the 18th of September contract here with 35 days to expiration, that's going to be just fine. We're going to go right down to the money. It's trading around 273 right now. So we're just going to buy to open this contract here, and we're going to find butterfly, and there it is in one single transaction. Now, in order to make this tradable, we do have to expand these wings a little bit. So I'm just going to go up 10 and down 10 just for this example. So we'll take this 274 and make that 283, and then the 272, we'll just make that 263. So up 10, down 10, this is what a standard at the money butterfly looks like. We can adjust these break-even points. And this is the standard trade. Now you can see down here how this is constructed. We are selling two of these strikes in the middle, that's that 273 strike, and then we are buying one contract each on the outside, the 263 and the 283. This means that our max profit is right here in the middle, and then because we're buying the outer wings, we have capped maximum losses on both sides of this trade. And that's easy to calculate, it's just the premium that you pay times the option factor of 100. So on either side, this trade can lose $184 per one contract. So what the broken wing butterfly does for today's video is it takes this standard trade and then it shifts some of the risk to either side of this. So let's say you thought the Qs were nearing a top, and maybe you thought the probability of a decline was higher than the continuation to the upside. You know, after all, it has screamed pretty high. Maybe you don't want to outright short it, but you do think that the likelihood of going down might be a little bit higher than going up. In that case, we can just bring this lower put strike a little bit closer to the center strike. So if we take this 263 and we make it 268 instead, now what we've got is a broken wing butterfly. So now there's no loss in the direction that we thought it had a higher probability of moving towards. And all the risk for the trade is now shifted towards the side that has a less likelihood of seeing those prices. It is still a capped maximum loss trade. We can still only lose this set value, in this case $335 per contract. And then on the other side, it is also capped, but this time there is a little probability of success here. So in the VTS options portfolio right now, we are holding something very similar to this in our live trades. The strikes are a little different because we've held it for a little bit, but I did feel like given the run up in the Qs, it was a little more likely that it would chop around near the top or perhaps bleed down a little bit. Again, not predicting doom and gloom or anything, but if I do have to choose a bias, I feel like down is a little bit more likely. Now, if a person thought the opposite, let's say they thought the momentum would continue and more upside was coming, in that case we can just break the wing the other way. So let's take this back down to the standard trade at 263, and then take this 283 high strike and bring that down closer to the money, so 278. Now it's the opposite trade. We've shifted all of our risk to the low side, and it's now the upside that has a little bit of profit there. Again, the butterfly structure is still intact. We still do want the price to remain close to the middle. Our maximum profit is where there's no movement in the underlying, but we've now applied a bias to the trade where if it is going to go in one direction or the other, in this case the trader thinks the momentum will continue and it may actually go higher. You want to make sure that if you're right on that prediction, that you're not actually losing money. You don't want to lose money when you're right. You just want to structure your trades that, we're all wrong from time to time, and if you are wrong, you should expect to lose money or use stop losses, but you don't ever want to lose money when you're right. So if you do think it's going to continue to the upside, in this case, you can make a little money there. There's really not much more to it than that. We're taking a very balanced trade on its own, and just getting a little bit directional with it. It's a very safe trade, and it can be quite fun for those that do like to overlay a little bit of their market bias on trades. You may have noticed in the options world, we do like our delta neutral trading strategies. But without going all out long or short, the broken wing butterfly does play a little more conservative middle ground of slightly up or slightly down, which can be fun for a strategy to be based on. Broken wing butterflies are one of my favorite trades, and like I said, they are the basis for one of my more advanced option strategies called directional flies. Let's review those points. Broken wing butterflies are now delta positive or negative, depending on which side of the trade we've shifted that risk over to. This does mean they are now directional, which is why I called the advanced strategy directional flies. They are still theta positive, so the more time that passes, that contract will be gaining value. And they're also still vega negative, so decreasing volatility is advantageous. And this is also one of the reasons why they do make really good VIX trades for when we're trying to play for a decline after a volatility spike. I've got a video talking about that in more detail already. You can check that one out here after you watch this one. And lastly, broken wing butterflies are still limited gain and limited loss trades. So even though we can now lose a little more on one side than we could before, they are still capped maximum loss. So position sizing and risk management, it's all very easy because we know ahead of time what we stand to make and lose. So if you're at all interested in this strategy, make sure you claim your free trial on my website and follow some of our live trades. I do prefer to educate through doing rather than talking, so just check out our live trading portfolio and see if the VTS community can help you achieve your investing goals. See you next time. So if you're interested in options trading, go claim your free 2-week trial on my website. In that time frame, you'll definitely see a wide variety of trade types: iron condors, strangles, calendars, earnings plays, pairs trading. I have many profitable strategies that you'll be interested in. Come join the VTS community.